Hey, everybody. Welcome to another episode of the FinTech Hustle. I'm Ron Shevlin, Chief Research Officer at Cornerstone Advisors, and one of your co-hosts, joined again, of course, by Sam Kilmer, Managing Director of the FinTech Advisory Practice here. And we've got a great show lined up for you today. We've got two guests. The first is Peggy Mangot, Operating Partner at PayPal Ventures, where she's been for, I think, coming up about 2 years now. Prior to that, she was the SVP General Manager of Innovation at Wells Fargo. Peggy was also the founder and CEO of SparkGift, which is where I think she was when I first met her, so going a while back. And before that, she held senior roles at Google and Visa, so clearly she can't make up her mind whether she wants to work for big established firms or small startups, so we'll talk more about her with that. And also joining us today is Neil Underwood, co-founder and general partner of Canopy Ventures and president of Live Oak Bank. Neil co-founded Live Oak, Encino, and digital banking provider Aperture, and is on the board of a lot of fintech startups. And prior to being a founder of fintech companies, banks, and venture funds, Neil was general manager at S1, one of the early digital banking providers. So Sam, if it's okay with you, let's kind of jump right into discussion with Peggy and Neil. Peggy, I'll start with you. Most of our audience, our listeners, our viewers, whatever, are typically fintech technology providers, a lot of bankers, credit union folks, but not a lot of venture fund or otherwise investor types. So I would imagine that many of them think like I do, that your day is filled with just going out to breakfast, lunch, and dinner with fintech founders, hanging out at conferences, and maybe going to the beach down in Miami, where it seems like a lot of you types have migrated to recently. So set us all straight, Peggy, and tell us a little bit about what your typical day looks like.
Sure. I'll start with what PayPal Ventures Fund is, right? So we are a strategic VC. We invest for financial return in 4 broad areas. So consumer fintech, commerce enablement, infrastructure, which includes risk, fraud, security, cyber. And then our 4th and growing bucket is infrastructure surrounding crypto, blockchain, and NFTs, the broad crypto infrastructure play. And when you think about why we exist, so we invest for financial return. We don't require a strategic relationship or a business sponsor from PayPal. When you think about why we exist, we are an arm of PayPal that helps bring insights and market learnings back to the mothership. So, I came from innovation at Wells Fargo. That was one way of doing it. We had a large R&D team. We did proof of concepts, we did white papers. Having a strategic VC like PayPal Ventures is another way to essentially have an in-house innovation arm where you have people on the ground learning, not just from the companies that you invest in, but from all the companies that you say no to. And so that's a little bit of a broad overview of PayPal Ventures. We're investing out of our second fund, $500 million. We're a global team. We aim to invest 50% outside of the US. When you think about my day, so I'm an operating partner for the fund. So I have a team that our remit is a few things. So I'm involved in every deal that we do and every follow-on. So I need to get to conviction and work with the investing team so that the team is on board with new and follow-on investments. But also there's about 30 to 40% of our portfolio that is looking to do a deal with PayPal, right? They want to sell to PayPal, they want to partner with PayPal. So I have a member of my team that spends most of their time just, working the commercial angle and trying to help these portfolio companies with working within PayPal, whether it's relationship mapping, whether it's helping them with their pitch deck, but how can we make it easier for them to get to the right people to explore commercial partnerships or commercial arrangements. And then, yes, we do have an ecosystem play. So I do attend the conferences, and I do try to make myself available to companies that want to pitch PayPal. But I'm sure, as Neil can express further, there are so many good deals out there. There's so many great companies that it really comes down to, I would say, a bandwidth perspective. There's only so many deals that we can do, investments we can do a year. And so there's a lot of companies that we see that we want to see, and we can't invest, obviously, in all of the good ones.
Awesome. So a quick follow-up question to that. You listed 4 areas, I think, of focus. They seem very broad. Are there areas of the fintech and financial services world that you're not looking at?
So I would say, to be honest, we're doing less in US consumer, right? And I think that if you look at our US investments over the last couple of years, it's a lot more B2B. It's a lot more, I would say, embedded finance plays, infrastructure plays. And I think that's a little bit of the trajectory of fintech and the investing world, right? It was a lot, you saw a lot more deals happening in consumer in the years past. It's harder for us to get to conviction. And a lot of it is surrounding CAC, Ron, and you and I have had, these discussions about the neobanks and the neo advisors and how difficult it is for them to acquire and pull customers away and make it, from large institutions and make it their primary account, which these neo institutions need to make the economics work.
Yeah. So just to be clear, though, when you say not focusing on the B2C, you're really not focusing on those that are direct to consumer versus the B2B2Cs, or those
exactly.
that enable the direct to consumer firms.
I would say, yeah, we're doing less direct to consumer in the US. Right. Like globally, we think there's a lot of opportunity going direct to consumer, but we're just doing less in the US.
Yeah. Well, we're going to get a lot. I want to get, and Sam and I do want to kind of probe on what you're seeing that's hot and stuff, but let's get Neil into the conversation. And, same question to you, Neil, what's your day look like?
Well, I did not go to the Bitcoin conference in Miami, the boondoggle down there, but I am going to go to a crypto conference in the Bahamas. It's called SALT in a couple of weeks. And look, I mean, I think just a soundbite on Canopy, I think many might know our story, but just for those that don't, we've had close to 50 banks invest in our fund between 10 and 50 million. So we kind of are a venture fund, a strategic venture fund for banks. Our banks are our LPs. And we've successfully deployed Fund 1. We're on to Fund 2 and hopefully closing that out here somewhat shortly. But my day, it's actually, quite similar. It's a combination of listening to, we call them fintech prospects, but listening to these CEOs and their pitches, and then managing the portfolio. The only third vector that we have to deal with a little bit more at Canopy is we've got a lot of LP meetings, a lot of one-on-one bank meetings. We'll present to the bank boards about the future of fintech. We'll do thematic, one-on-ones or Zoom calls on specific things like identity, bank infrastructure, SMB marketing. Neo is a great one. So it's really a combination of those three. I think, look, we're a bunch of operators turned venture folks, much like Peggy, and I think we've got, great background, but relative to fintech and understanding fintech, but the context and the exposure of meeting with I meet with probably 4 fintech CEOs a day, just on 30-minute Zoom calls, hearing a pitch. And so do my partners. We have about 24 professionals with us right now, a team of 24. And, it's really interesting because you just hear so many different things. And I think this, the context and the exposure help one get conviction, or when you see something that's just completely different, and you just know this one's going to be a home run, you can kind of go deep. And so our fund actually we'll look at 1,000 companies a year, and we'll probably do 20, just to give you guys some aspect of the ratios there. And we like highly concentrated positions, meaning when we do see a company we love, we're ready to write a big check and own a nice piece of it, not control, way under control. But that's really been our thesis thus far. We're going to continue that same thing into Fund 2.
Is that a wire transfer or an actual check, or are you using bill pay on that one, Neil?
Yeah. It's funny you mentioned that, Sam. People still use the word check. They're going to write a check. And it's like, man, you think for being in venture and technology, we'd actually use, another way. All right, we're going to change it into a cryptocurrency, and we're going to move it via crypto to the checking account, the operating account. How about that?
Well, we could just use PayPal. I mean, that's
there you
the
go.
other
Amen.
But I think one thing that's just I'm darn curious about, because you're seeing so many. Peggy, you mentioned more transactions than you really could even have time to participate in. You mentioned kind of B2B to C, and also embedded finance. But I was just kind of wondering if there are any areas when you just think about what's hot right now for you, for each of you, what's hot, and like, I guess the other thing is what's maybe not cold, but what's cold or lukewarm that maybe you think ought to be hot. And I don't know, Peggy, if you want to give it take a stab at it. I'm just genuinely curious as to what you're seeing right now, that or any categories of things beyond your big four, or maybe some subcategories in there that jump out at you as being hot or should be hotter.
Sure. So one area within crypto, which I use as an example, especially when I'm talking to people that are just getting started in crypto, I talk about the desire for a consumer or a business to get better yields on their accounts, right? On their cash holdings, right? Everyone can understand that that their current bank or their current personal bank account or treasury management account is not paying very much yield on the cash in the account. And so when I look at I would say a more obvious use case, it is who are the companies that are going to help unlock greater yields for consumers and greater yields for treasury management. And so that area, that enabling crypto technology or companies that are going to enable that and sell into banks to enable that for their customers, I think is going to be an area of adoption that it feels obvious to me and that we're going to see more of. And so it's this risk-adjusted access to higher yields. And I'll pause there because I'm curious if Neil is looking at that as well.
Yeah, Peg. Well, first of all, on the crypto side, we kind of share your view. We kind of love blockchain, crypto infrastructure companies. It's happening out there, and so the question is, how can we as a sector in banking or even in fintech, make sure we have all the reg and compliance wrapped around the stuff that's happening? And that seems to be a bit of a moving target. And but there's some companies that clearly have stood out in that particular subsector. You guys have mentioned embedded banking. I think that's one of my favorite, or embedded finance. It's probably one of my favorite topics to talk about. I literally just got out of a 2-hour meeting at Live Oak Bank on the concept of embedded finance. So it's and I'm starting to hear CEOs talk about it on earnings calls. And I think it's just recognition that consumers and SMBs aren't going to be going into branches anymore. And how do we embed our financial services companies in other software such that accounts can be opened there, money can be moved there, credit can be established there. Plaid and Stripe are great examples of API first platforms that are selling to developers. And I think banks have to kind of ultimately follow that same path. A couple of great little technology companies that popped up along the way to help banks do that. But I think the business of embedded banking for financial services companies is going to really quickly evolve here in the years to come. And I think it has to be a different way of thinking, embedding your bank, whether it's loans or deposits or payments, into another e-commerce app. Great example at Live Oak. We're out there looking at practice management software providers, such that when a veterinarian enrolls in a piece of software, the last step on that enrollment is a little logo, a Live Oak Bank logo, and through elegant APIs, new account opening APIs, which are something very different. Industry hasn't really solved for that. When you've got new account opening APIs, you can do that and then go back in and stay in the experience of the e-commerce platform or the practice management provider.
Right. No, absolutely. And we've looked at that a lot as well. Like what's the what are the next like vertical software that are serving these different industries, right? We have some of the obvious ones we've seen already, but like you just mentioned, like veterinary care, right? We've seen like dentistry. We've looked at beauty and salon vertical software, and the different fintechs serving that vertical software and embedding it into the experience. And I'll just a quick plug on the back to the crypto. We share your thesis surrounding like investing in the infrastructure that is helping to make crypto regulatory compliant, tax compliant. So we are an investor in TRM Labs, which is AML for
love TRM Labs. That one got away from us. Damn.
Sorry. and TaxBit, which is helping companies be compliant with the tax requirements surrounding crypto holdings.
Yeah, just a quick comment on that, because we just recently completed a consumer survey about consumers' interest in getting accounts and doing financial business with non-financial providers. We'll have actually a series of reports. First, they'll come out soon. But one of the things that we kind of found I thought was interesting was that, yes, there's a lot of interest from a general consumer perspective. But when you look at it from a small business owner perspective, it was huge. And the other big opportunities were gig workers and gamers. The gamer population is absolutely huge globally, and they are interested in being able to interact and transact seamlessly within the game environment, which kind of begs the question: what do you guys see as future opportunities from a metaverse perspective, more than just gaming? Neil, you want to start there? Then Peggy will ask you the same thing.
Sure. Look, I think on the gaming side of it, that's a quite interesting approach. I mean, that's another example, in my view, of embedded banking, where you can embed a bank or financial services company inside. Look, the metaverse to me, I just think it's still very early days. This is, folks have tried this before, and I actually even bought an Oculus device and played around with it for quite some time. I mean, the experience is truly immersive and interesting. I just don't know that I'm going to be in that for 8 hours a day. And so I still think, and this is probably not a popular view, but I just think it's really early days. So those that are staking their virtual claims, whether they be virtual branches or stores, I think it might be early there. However, it's something we're watching quite closely. We haven't made any investments in the space just yet.
Peggy, what's your take?
So we had a thesis surrounding like the creator commerce, and based on the research that we did, that was in 2021, we invested in a few companies, Caro, Cameo, and the third is Stream Elements, which is it's a company that enables streamers to engage with their fans and also monetize surrounding those fans and also monetize with brands. So when you think of like streamers, it's mostly gamers globally. And this infrastructure play is helping these gamers monetize and engage with their fans. And so we definitely see opportunity in gaming. I think, and that was 2021. We looked at it like from a creator commerce and less of a crypto metaverse type of lens. Going into 2022, it's early for us as well, but we're looking at, what is the crypto and gaming crossover? Will it be NFTs that can be used in games and but then are portable, right? Like, they can go outside the game. So for us, it's a little bit early, but it's definitely exciting. And the NFT world itself has about 5 different subcategories that are equally exciting, surrounding not just art, but access and in-game skins and points. So it's really exciting. We're looking to dig in more.
Peggy, following on, I think, that is super interesting in terms of the gig. You mentioned the gig economy as the sole props. We do like investing in that particular market segment. We love the macro trends of what's happening there. And we do see more products, kind of being presented to that particular market segment. So we have our eye out on that as well.
Hey, I just want to run a theory by you guys and get your kind of reaction to it. I couldn't tell you whether the metaverse will be big or not, and don't really care about that. But at the moment, I think there's this huge opportunity for banks, financial institutions, not to create or start up branches in the metaverse. I actually think that's one of the stupidest ideas I've ever heard, and we can fight about or argue about that later. But I think there's this huge opportunity right now to be the lender. And I don't think of them as mortgages. They're not mortgages of buying land. It's more of to me, it's more akin to a commercial real estate investment. You've got to assess the business plan of the borrower, or how they're going to use the land in the metaverse, whether they're getting it from Decentraland or, wherever they may be getting it from. Neil, from a Live Oak perspective, do you see any opportunities to kind of be the lender of choice into the metaverse?
Sorry, April 1st is behind us, because I swear what I'd love to do is take that to my chief credit officer and say, hey, look, I got a great new vertical for us. It's going to be lending to land in the metaverse. Look, I think that can be real over time. I just think the underlying, it's going to be hard for banks. You're going to get alternative lenders maybe to do that. It's going to be hard for banks and a chief credit officer to understand, the collateral, the underlying collateral that's there. And you can say, well, no, look, here are some bona fide trades that are happening. But I see that they would probably be pretty volatile. And who knows whether Metaverse 2.0 that comes out that is in a completely different world is going to have, so the only challenge there is back to supply and demand. There truly are unlimited worlds that can be created virtually. And so it really, in my view, at least anyway, brings into question, okay, how does one truly value the underlying asset as collateral, to do a loan? But I'm sure I'm probably wrong.
That's so interesting to me, because it's like, well, first of all, you need to tell the chief credit officer that it's going to be collateralized by a stash box from Snoop Dogg. That's your yeah. You need more collateral than that. I'm sorry, but you're pushing too hard. This is the new world. But what I think is interesting about it is, even going back to when I was a banker and making my first choice around which digital banking platform it wasn't it always interesting? Is like, okay, would I loan this company money versus what I buy tech from it? And it's always been like, well, are we using the same metrics? Are we using the same values? And I think we're trying to get there, where it's sort of one conversation around what's considered valuable versus not, and kind of the future view. I don't know. Do you guys have a do you have a formula to how you view valuations, or do you follow, do you follow sort of like some type of an adopted methodology that you've brought in, or have you created your own way of, we've got 5 things we look for, and 2 of them are wholly economic, and 3 of them are, sort of like, this kind of thing? I mean, how do you look at valuation? Since you brought it up there, Neil, on the think about the chief credit officer, I don't know, Peggy, any thoughts on how do you guys look at values, and whether or not you think something is overheated or undervalued?
Sure. So we have standard methodology where we look at the company's their P&L, their forecast, their execution against plan, and then we also do a return analysis, right? So what needs to be true for them to deliver X return, and then part of that return analysis compares comps for other companies that may have exited, to give us a direction for, whether the valuation, the current valuation is reasonable, and the return we expect from the investment is on track as well. However, these last couple of years have been a little bit wild, I think, for everyone investing.
Yeah, no, I'd add on to that, like growth and gross margin. Last year, literally, there were just a couple metrics, growth and gross margin. If you had great growth, kind of tripling growth, and, kind of best in class 70 to 80% gross margins, people would be clamoring for that company, and valuations would just go up. And it's, the multiples on ARR, annual recurring revenue, which is monthly GAAP. This man always loves to tease me, because Rarely do we talk GAAP, but the last month's GAAP revenue times 12, and then a multiple on top of that are kind of how, I mean, look, 3 or 4 years ago, the multiple may have been 10. I've seen it go up to 40 or 50 in some odd cases now for the exact same property, the exact same growth characteristics. And so those are ones you're going to have to stay away from because they're overheated. They're going to have a really difficult time when we underwrite them in venture. We're underwriting them to a return. Can we do a 5x or a 10x?
Right.
And when those valuations are that high, just the risk of being able to underwrite it to that metric is going to be really, really difficult. So, the new this year has brought in something completely different. The public equity market meltdown, now feeding into later stage growth. It's got a lot of folks, those crossover guys like Tiger and others are like, man, what's the right price to pay for a later stage growth, given the IPO exit may not have the same profile, or probably won't as the. So we're seeing some of that revalue come into play. Some of the metrics we're looking at now are burn to revenue. So we want to make sure, a company doesn't have a Series C burn with the Series A revenue, even if that revenue has great growth characteristics. So, the efficiency of the investments are now being looked at and scrutinized way more than a year ago when it was just the Wild West of valuation.
So question for both of you. Peggy, I'll start with you. Which fintechs are overvalued right now? Who will you not invest in the next round because the valuation's already too astronomical? See, Neil, you get 30 seconds to think about it. Sorry, Peggy, to put you on the spot.
No, that's okay. Look, I would say many of I'm not going to point to one or two companies, but I would say many of, if you were to Google companies that canceled their SPAC, but then raised privately, we would not invest in those companies. And so what we started to see is many of the SPACs, like many of the companies that were going to SPAC, were not able to get the valuation in this current environment that in the public markets, that they're able to get in the private markets. And so they were able to raise in the private markets at high valuations. And I think time will tell if the public markets turn around by the time they are ready to go public, if that's going to work out for them.
Yeah, look, my quick answer would have been no comment specific to a company. That wouldn't be quite fair, but I would have maybe have us look at the profile of a company that we just would give an automatic no to. And it's connected to the way the burn that we talked about before. There are companies out there that are just not efficient. They've hired a ton of people in a pandemic. One has to question the culture if there's a massive amount of burn ahead of the revenue. And so we can take a quick look at the P&L and, give, no matter what sector or subsector the companies in, and kind of give a quick no. So again, path towards profitability is a thing that, we're not requiring of all of our companies, but you just have to see kind of how efficient they are relative to the TAM, the market, and the market size. So I think those are some quick ones. And then, I think the CEOs that don't have the experience to, navigate a cycle, if the numbers, are just kind of soft, then, you kind of hit the no button. We are seeing, it's a bit of a tale of two cities. There's some really hot companies out there, and everybody wants to invest in them. Like all the usual suspects are on the table, driving up the valuation. But if it's not a perfect story, meaning the growth isn't perfect, the burn's a little bit ahead, the leadership team's good, but then those are getting significantly discounted in our experience.
Very interesting.
And I'll just make a comment that's somewhat related. So what we're seeing is not just the venture side, but it's also the recruiting, right? So a lot of top talent it's harder for these later stage companies with really high valuations right now. It's potentially hard for them to attract top talent because this top talent has options and they're worried that it's going to take too long for the company to grow into the valuation that they have, given, Square is down significantly and public company comps are down significantly. Even late stage private valuations for some of them have come down. So I think it creates a talent problem as well.
That's really well said. And look, it forces us to think about maybe even earlier stage. We love the term incubation, where it's pre-product, pre-revenue. We meet a great CEO that has a great idea. We validate it with, partners like Peggy or banks that are out there say, hey guys, what do you think? Does this fill a void? And, if the answer is yes, then, we'll all put a little bit more in on that and then be able to be there for the ride up.
Really interesting. I think also the perspectives that I heard from you, that kind of back to your point earlier, Neil, about, what am I going to tell my chief credit officer? And I just think it's really interesting that both of you are former bankers. It's sort of, I think we run across people every day, Ron and I do in our world, and I'm sure you do as well, that many of them haven't been bankers before. They've been tech entrepreneurs, or they've been sort of serial investors, serial startup folks. It's all good stuff. I guess one thing I'm just curious is, when you guys look back on the fact that you were bankers, do you think it's helped, like in what you do every day? Do you think your experience as a banker has helped you, and how, or not? Has it held you back? Has it made you think perhaps too conservatively? I don't know. Neil, if you want to give a first shot at that.
No, I mean, look, I think it has certainly helped. Running a bank for 10 years, going to the regulator meetings, and examining the findings. And so it's just the discipline around understanding all that is regulatory compliance. I think many of the fintechs that don't have that experience, quite frankly, underestimate that element and what it means to run a financial services company. I still remember, it was Lending Club and On Deck, their public filings, their S1 2015. I'm dating myself here, but they just were flaunting the fact that, they didn't care about regulatory compliance, banks suck. And, ultimately, I think they all, 5 years later, found out that actually that stuff really, really matters, whether you're a bank or not. And so the other thing is, we see a lot of convergence happening where some of the bigger fintechs, some of the neos even, that have these really horrible interchange only models. They've spent, $100 to acquire a customer, and the LTV, the lifetime value, is really not there. They're going to have to increase their average revenue per unit, or their ARPU, and cross-sell products. And if they're going to cross-sell products, one profitable product can be lending, but if you're going to lend money, you kind of probably need to be a bank ultimately, and not rely on capital markets to fund. So, we think there's going to be some of this convergence where you'll get these fintechs that are acquiring banks. It's already happening. You've seen, between the SoFis and Square by getting the ILC charter. And I wonder what that first regulatory exam is going to be like, when you've got a bunch of the, just the culture of that, coming in and trying to understand the bank side of it. I think there's going to be some lessons learned.
Hey, Peggy, any thoughts on your experience as a banker and whether they've helped or not? Or
yeah. I mean, I love my time at Wells and I would say at more traditional financial services companies like Visa. Those were tremendous experiences, and it definitely helps me in investing. And I'll say a couple of reasons. Like, yes, I understand the business a lot better, after being on the inside of those two companies. But I think the value that I can give to our portfolio companies is helping them sell to banks, like sell into Wells Fargo, or sell into PayPal, or sell into Bank of America, because I understand kind of how they think about buying. And yes, the sales cycle is long, but it's not a rip and replace. It is how can you help this bank solve this particular problem, be it around risk or account open or identity. And then, and then it becomes, this is how I advise them at least. And like, how can you incrementally help them? And then what are the basis points? And then what are the total accounts whether account they open or logins per year or whatever? Because it is a land and expand strategy for large banks. And so that's what I work with them on. Like they're not going to rip out their entire risk fraud system. And they have very smart people and they have lots of, I would say, partners and vendor relationships. You will be one of many. So it's helping them with that pitch and that sales process, that enterprise sales process, and all the wraparound that goes into those meetings, like who they should be talking to, what white papers that they should be referencing, and how you can show the math potentially that is going to get the attention of these business leaders, these business buyers.
Really interesting.
Yeah, well said.
Guys, I think we are pretty about up to our time limit here. So I want to thank all of you and Peggy Mangot, operating partner at PayPal Ventures, Neil Underwood, president of Live Oak Bank and managing partner at Canopy Ventures. We really appreciate you guys taking some time to join Sam and I on the FinTech Hustle. And for everybody listening in, watching, whatever, thanks a lot. And we hope to see you at the next episode of the FinTech Hustle. Thanks a lot.